Hello, I'm Brian Gray.
And I'm Ray Stein. We're advisors with APO Financial. And today we're going to talk about a question we get a lot from our online and in-course teachings, which is, how is Social Security earnings that you're taking in taxed? And actually, the interesting part is they weren't taxed when it was originally designed. That income you got, which feels like a tax coming out of your paycheck every week or every 2 weeks, right? It goes out. When it comes back in, it used to not be taxed, but it was part of a temporary tax, right?
It was a temporary tax back in 1983, and it was coming right out of a recession, coming out of the late 70s and the early 80s. So the country was struggling with high interest rates at that point. We were in a recession, and ultimately they were looking for ways to actually drive tax revenue to fund the U.S. government for those years. And, as we always see, a temporary tax, always be careful of temporary, because it generally becomes permanent as it relates to taxation. But we want people to be aware of that Social Security can be taxed. And it all depends on different thresholds. And it is based on three different main brackets. One is a married couple. And actually, once one of you passes away, then you become a widow, widower, or even single. Those thresholds are a little bit lower. But, we've always been, taught that, generally you'd be in a lower tax bracket in retirement. But what we found by doing lots of plans, that we've seen most people are actually either in the same or actually slightly higher tax bracket later in retirement.
They are, and it's been this way for a long time. The government finds a taxable revenue, they make it permanent. So I wouldn't be surprised down the line there can be other ways with our big national debt right now to find taxes. And we always we're very tax sensitive when we talk about the tax plan, because we think the target is on those retiring today. It's on their backs due to the transfer. So Social Security taxable brackets, there is a way to keep your income low enough through other types of income sources to make sure that Social Security is not taxable. Because once you get over those thresholds that Brian talked about, 85% in the top end of your Social Security income is added to your taxable income. Depending on the bracket you're in retirement, that can actually be pretty high with the RMDs we talk about, minimum distributions in the other video. That can all stack up to where you can be paying a lot of taxes in retirement potentially.
It's so important. And we're not just talking about federal income tax, but in Colorado, for instance, they actually do tax Social Security at the state level as well. So when you start looking at it, it might be a good idea to actually write your congressperson and say, you know what, it's not good for the state to tax us as well as the federal government, because when you start looking at Colorado that has a surplus, and from a tax revenues perspective, they shouldn't put the onus of running the state government on the shoulders of people that are already retired. And when you start looking at the impact of tax as it relates to Social Security, you get your gross amount there, then they take the taxes out. Both federal and some states take out tax as well. But then you have your Medicare premiums taken out as well. So the net benefit coming from your Social Security check after tax and Medicare premium payments, that actually winds up being a smaller amount. And with cost of living adjustments on Social Security, it hasn't been as much as it has been in the past. And what we're finding is maybe 10, 15 years from now, people are going to start struggling with more take-home income coming from Social Security because of the tax impact.
Yeah, it's huge. And the good news, though, is if you have a little bit of time prior to about 70, 71, you can do a decent tax plan looking at things like Roth conversion strategies. There's a handful of ways to do that. So that way you're starting to build up that tax-free income for you later in life. So you're not 100% of your income susceptible to whatever the government says the tax rate is in that year, because it's what we call policy risk. But if they just change, the laws, you can be in a much higher tax bracket than today. So it is a risk out there. Social Security is a part of that risk that you can potentially get a lot more tax efficient with.
Absolutely. And so when it comes to income planning, Social Security is the foundation of most people's plans. And when you start looking at it, you got to look at the tax impact and how it's going to impact your lifestyle. For us, we just wanted to make you look at all avenues of your money there, so that way you can focus on living your life and not having to worry about taxation. So again, you only have one life. We want you to make sure you get out there and giddy up and make sure you live the life you want to live. So don't hesitate to do that, but reach out to us for more information. We'd be more than happy to walk you through that.
Thank you very much.
Thank you.